So, welcome to the Breakfast Show. I'm Sean Chung with your US Markets Wrap this morning. As Wall Street awaits a pivotal debt ceiling meeting and government officials scramble to avert a default, the S&P finished little changed yesterday. It inched up just about 0.02%. Meanwhile, the Dow Jones Industrial Average lost 0.42%, ending in at 33,286 points. Monday's move pushed the Nasdaq Composite up by 0.5%. It settled in at about 12,720 points, bringing the tech-heavy index to its highest close and the highest intraday level since August. So we are just 10 days till June the 1st. That's the earliest day that Treasury Secretary Janet Yellen says that the US could realistically default. That seems like quite a lot of headwinds and a lot of drama that could still ensue. So let's unpack all of this. And with me, I got Dave Sekera, the Chief US Market Strategist at Morningstar Research Services. And he is speaking to us from Chicago. So good evening, sir.
Oh, good morning to you. How are you?
Yeah, it's good morning to us. How are you? I'm good. It's a bit early in the morning for me, but there's nothing that will keep me up and awake and all energetic to think about what happened if the failure to raise the US debt ceiling beyond the current levels cap of roughly 31.4 trillion by June what could it result? Right? Could it be in the US defaulting on its debt? And so on. So are we looking at a last minute deal perhaps? And if not, then what could be more damaging than the government shutdown? What is the scariest thing that could happen?
Well, first of all, I just have to note, from my perspective, I think the potential for a default on U.S. Treasuries is what I consider to be a very low probability, but yet high severity event. And so I do fully expect that there will be an agreement that's made and the U.S. will not default on its securities. However, I don't foresee an early conclusion to the debt ceiling negotiations. I think both political parties will probably try to use this to score political points with their own base. And so I think the negotiations will probably last up until very near the deadline before the Treasury would run out of cash. Now, if there were a payment default, I do think that just based on the size and the scale, the amount of U.S. Treasuries outstanding, I think this would be unlike any other sovereign default that we've seen. Now, having said that, I don't think investors in treasuries would end up suffering any losses. I do fully expect that the debt holders would end up getting fully paid once the debt ceiling is lifted, and they may even get interest after the maturity date and they get their debt repaid. Now, there's really no way to know exactly what all would happen. Now, personally, my biggest concern is going to be on the funding markets, those markets that do use U.S. Treasuries as collateral. And a lot of those funding agreements typically include language that they can't use defaulted securities, in those arrangements. So the result could be that there could be just a huge unwind of those facilities. Borrowers end up becoming forced sellers. And of course, that selling pressure in turn really could send markets, worldwide reeling.
And it looks like the market has priced in that all will be well, and the VIX looks really, really low right now. It's like $17, and so that seems to suggest that they're not so concerned about this catastrophe happening.
Yeah, I think most institutional investors are pretty much in the same vein that I am, that we do fully expect that there'll be a lot of noise between now and then, but by the end of the month, before the Treasury runs out of cash, they will get to some sort of agreement, some sort of deal will get done.
So let's see what happens. We understand that there'll be further talks later on today between both sides of the aisle. Recent gains we're seeing in the tech heavy Nasdaq, though, is that a blow off or is that a panic bid?
Well, in my view, it's actually, I think, a little bit of neither. So, a significant amount of the rally that we've seen in the NASDAQ this year has been driven by the technology sector. In fact, if you look at our indices, the Morningstar Technology Index has risen over 27% year to date, versus the broad U.S. market, which is only up a little over 9%. Now, I'm not surprised. Tech was actually the second most undervalued sector at the beginning of the year, according to our calculations. And I'd also note a lot of this rally has been driven by some of the largest, market cap stocks, stocks like Microsoft, Amazon, Nvidia, Alphabet, Meta, Tesla. These were all stocks that we had rated, 4 and 5 stars at the beginning of the year. They're all up well into the double digits. I think Nvidia has almost doubled at this point. So many of those are trading, much closer to fair value in our mind. However, at this point, I would say tech is getting pretty close to our intrinsic valuations. And so I've been talking to a number of investors, and I think now is a pretty good time to actually move from an overweight into a market weight in that tech sector. Some of the other sectors we see better value today is in the communications sector that still remains, very undervalued, as well as a lot of the cyclical sectors, basic materials, consumer cyclicals, financials. Those are the sectors that we still think, the market is, too negative on. Whereas some of the defensive sectors, those that actually held their value best to the downside last year, those are pretty fully valued here, and we don't really see too many more opportunities in those.
Well, yeah. Speaking of which, so let's take a look at some of the moving average, the moving averages. I think Nvidia is like 120% above its 100-day moving average. Microsoft is 36% above that moving average, the 100-day moving average. So, is there really more upside to come, you think, or it's just this train has just left the station already?
Well, Nvidia is one that I would actually be especially cautious of for investors today. While that stock was very undervalued coming into the year, now that it's more than doubled, we think it's actually significantly overvalued at this point. We rate that 1 star. That's the lowest of our star ratings. I think it's over 50% overvalued according to our valuations at this point. I believe the company is actually reporting later this week. So, we'll see what the company has to say. But, a lot of the rally in that stock has been due to its business in artificial intelligence, and investors, have been, very excited about that business. So I am cautious going into earnings, and we'll see how that plays out. But some of these other stocks, do still have, a little bit more to go to get up to intrinsic value. It's just that at this point, I do think with the market being, towards the top of its trading range since last fall, I do think it'll be, a while, probably not until late summer or maybe the fall, that we could see leading economic indicators in the U.S. turn around and really get to the point where we could break through the ceiling that we've been bumping up against.
Yeah, and another big piece of news that has been happening yesterday. So China has banned Micron out of security concerns. Micron down 3% on that news yesterday. What should we expect from these developments? Because I think it's unlikely that Micron will be the last, right? I mean, China could easily do the same to an AMD, for example. So what does that make you think, not just about Micron and the stock, but about that space right now?
Yeah, so the semiconductor space, in and of itself, there's definitely a lot of transitions going on. The United States is taking the political position that they're trying to, bring back onshore a lot of that chip manufacturing that has been, offshore. And we've certainly seen, a battle between, the Chinese government and the U.S. government on, a lot of these high-tech chips. So I do think that will, continue for a while. But I also do think that does give, investors, some opportunities, specifically looking at, a lot of the companies that make the manufacturing equipment that actually is used to make semiconductors. We do see a lot of value in a number of those companies today. ASML would be one that I would highlight to investors to take a look at.
Right. And also, let's take a look at oil prices. I think they were held in check by a stronger dollar as the market waited for news on the latest waits for news on the latest debt ceiling talks. Prices basically are edging up. Well, they edged up 1% on Monday. So what are you seeing there, and what could that impact on other sectors as well?
Sure. So for the oil industry, specifically, we do think that prices are higher than what we expect over the long term. Now, here in the short term, with some of the actions that we've seen out of OPEC and some of the lack of new production, in the United States in the shale area, we do think that the oil market is going to be relatively tight. That will keep oil prices relatively high, over the short to medium term. But we do think that over the longer term, we do expect oil prices to start coming back down. In fact, our team has kept a $55 a barrel price target for West Texas Intermediate, $60 target for Brent. So when I look at the energy sector overall, we think the sector is pretty fully valued. We're not seeing a lot of new opportunities there. And in fact, that was one of the sectors that we thought was overvalued coming into the year. And I know the Morningstar Energy Index has fallen about 10% year to date. So again, it's probably a good market weight after being an underweight earlier this year.
Right. And okay, thank you. And I think that's just a step away from oil and tech for a while. I want to talk to you about Disney, because Disney shares, they've declined about 2% last week. They're down 8% for the month. Thereabouts. It's hitting in about just slightly under $92 right now. So is this coming off the back of the $867 million Florida plan? They scrapped it. And of course, the escalating feud between Disney and Ron DeSantis, the governor. So what would you say, could this current tailwinds, cloud its longer term potential for Disney?
So with Disney, in my opinion, for long-term investors, the news regarding its decision to cancel that project is not necessarily material to our valuation, in and of itself. And in fact, I assume there's a lot of other factors that went into that decision, other than just the current feud that we're seeing, between Disney management and Governor DeSantis. I think more material to the value of Disney and what investors have really been questioning is going to be its ability to expand its Disney Plus streaming business and really start driving long-term profitability there. Disney has been struggling with that business, but we do think Disney is probably one of the few players in the streaming business that we think has enough content and has the breadth of a catalog that they will be successful with that over time. It's just going to take a while for that to play out. I'd also note that we're also encouraged by the return of Bob Iger. He's retaking control of the company, and I expect that the changes that he's putting in place will help unlock value over time as well. So when I look at Disney and I look at the fundamentals, I would note that is a company, we do rate it with a wide economic moat. So essentially, we believe that company does have long-term durable competitive advantages that will allow it to earn excess returns over time. We do rate the stock right now with 4 stars. And our fair value on that stock is $145 per share. So it's trading, well over a 30% discount to our fair value right now.
Yeah, there's quite a lot of upside to go. Dave, they're also removing content of Disney Plus. So, but I think if they do remove any Marvel content, people are really, really going to get very angry. So thank you, Dave. And you have a good evening. And thanks for your
All
time.
right. Well, thank you very much.